Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Yeah, and there's definitely a lot happening right now. It's pretty chaotic out there.
Oh, absolutely. I mean,
Yeah.
just looking at last month, March of 2026, we saw some wild volatility. And get this, just because of a minor math miscalculation regarding market swings, a bunch of computer algorithms dumped like $108 billion worth of stock.
Right. Just mechanically sold it off.
Yeah, completely ignoring how the actual companies were doing. So, it really makes you wonder what on earth is going on Wall Street. And that is exactly the mission of our deep dive today. We are looking at the traditional 60-40 portfolio,
Yeah.
that classic safety net for, your everyday 401k, and why it's showing some massive cracks right now.
It really is. I mean, for decades, that 60-40 split, 60% in stocks for growth, 40% in bonds for safety, that was the ultimate undisputed golden rule of investing.
Right, it was like a playground seesaw.
Mhm.
Like if the economy hit a speed bump and stocks slammed down, the bond side of the seesaw would naturally rise up and keep your whole account balanced.
Exactly. Stocks are your gas pedal, bonds are your brakes. But if you look at the recent data, someone basically broke the seesaw. Since 2020, and especially now in 2026, stocks and bonds are just dropping together during these short market declines.
Wait, dropping together so the brakes just aren't working at all.
Not really, no. The International Monetary Fund actually put out a blog back in February of this year pointing this out. And BlackRock's 2026 Insights explicitly warn that the historical stock-bond correlation is just becoming less reliable.
Wow. I mean, I guess we saw that firsthand just last month, right? When the Iran conflict flared up in March. Usually when a geopolitical crisis hits, everyone panics and hides in bonds.
You'd think so, yeah. That's the textbook move. But instead, the FTSE World Government Bond Index actually saw its biggest monthly drop in a year and a half. Reuters even reported that the Iran war completely exposed the sheer vulnerability of this whole 60-40 setup.
Because even in a crisis, bonds couldn't act as a shield.
Exactly. And a follow-up Reuters report on April 8th noted that global bond markets aren't going to easily return to those pre-war levels, even with ceasefire hopes. The whole dynamic has shifted.
Okay, so if bonds aren't our automatic safety net anymore, that puts a lot of pressure on the stock side of the portfolio.
Yeah.
But the stock market right now is basically just leaning heavily on a few giant AI companies.
Oh, heavily is an understatement. It's incredibly concentrated.
Right. So if you think about it, aren't we basically riding a unicycle instead of driving a stable four-door car at this point?
That is a terrifyingly accurate analogy. Yes, you are on a unicycle. BlackRock specifically warns that the AI theme has gotten way too big inside traditional index funds. They're calling for targeted diversification because right now you might think you're diversified across 500 companies, but your money is really just tied up in a handful of mega caps.
Which is so risky. Like if one of those AI giants trips on a pebble, the whole unicycle goes down.
Exactly. Reuters actually noted back in January that even if market leadership tries to spread out, those mega caps are still taking the lion's share of earnings growth. And investors are totally waking up to this reality.
Are they? I mean, are regular people noticing this?
Oh, the money flow proves it. In early April, we saw continuous inflows into large cap stock funds, but at the exact same time, bond funds had their first weekly net outflows since late 2025. People are pulling their money out of bonds because they realize the 60-40 skeleton isn't a full suit of armor anymore.
So they're ditching the broken brakes. Okay, well, since we can't just hide in bonds anymore, we need to talk about the solutions. Based on the research, we're going to break down 3 specific new engines or upgrades that you can add to your financial vehicle.
Right, because you have to adapt to survive this market.
Exactly. So let's start with the first one we found in the data, which is called liquid alternatives. Now, I like to think of this not as a whole new engine, but more like installing heavy-duty shock absorbers on your car. Shock absorbers that honestly don't care if the road curves left or right or goes completely off a cliff.
That's a great way to put it. The whole goal of a liquid alternative strategy is to seek what we call alpha, which is pure skill-based return without relying on the market's overall beta, which is just the general direction the market is moving.
Okay, wait, let's pause there for the listener. Alpha and beta. Give me a really simple way to visualize that.
Sure, so imagine you're on a boat. Beta is the tide. When the tide comes in, all the boats rise, right? Good boats, leaky boats, they all go up together. That's beta. Alpha is the actual skill of the captain navigating through a storm regardless of what the tide is doing.
Ah, Okay.
Eh,
So liquid alts are basically hiring a really good captain instead of just hoping the weather stays nice.
Precisely. BlackRock pointed this out in late 2025. When the market is super concentrated in a few megacaps and markets move as one, you need tools that prevent you from just making a binary coin flip bet on whether AI stocks will go up or down, or if interest rates will go up or down. You need to change the correlation of your portfolio.
But hold on, let me push back on this a little bit. If we look at the data from March 2026, when the Iran war caused all that volatility,
Hmm.
the hedge fund industry, which is full of these supposedly great captains, had its worst month in 4 years. So, I mean, the shock absorbers can clearly break, right?
Oh, absolutely. They absolutely can break. And that is a crucial nuance you have to understand. Traditional long-short equity managers suffered massive losses in March. Liquid alternatives are not some magical asset that always prints money. They're a tool to slice away concentration risk.
So why did they fail so badly in March?
The danger is right there in the name liquid. Daily liquidity means that in stressful times, when everyone panics and wants their money back today, these managers are forced to rapidly sell off their best positions at terrible prices just to meet those redemptions.
Oh, wow. So it's like a bank run, basically.
Yeah.
The captain is forced to sell the ship's engine just to appease the passengers.
Exactly. It's meant to slow down a market shock, but human emotion and panic can still cause massive damage.
Well, speaking of human emotion, if human managers in liquid alternatives can panic and ruin the strategy, why not just hand the keys over to a computer? Which brings us to the second engine we found in our deep dive, systematic trading.
Yes, the rise of the machines.
Right. I'd compare this to a car's advanced autopilot. Instead of a human driver getting road rage or hyper-focusing on one specific route, you have a system looking at millions of data points and maps simultaneously to find a tiny statistical edge.
That's spot on. According to BlackRock's 2026 trends, the integration of large language models, or LLMs, and advanced machine learning is giving systematic investing this incredible, unprecedented research depth.
Because it can read everything at once.
Exactly. It's about finding repeatable statistical advantages across a massive universe of thousands of stocks with total precision in risk management. No emotions, just data.
Okay, but, and this is a big but, if all these massive Wall Street firms are using similar autopilots, programmed by similar tech guys, and the market hits the sudden pothole, don't they all violently swerve in the exact same direction and just cause a massive 100-car pileup?
Yes, you hit the nail on the head. That is the exact risk. And we actually saw two very different versions of this play out just last month in March. It is vital to understand the difference here.
Wait, really? Two different versions?
Yeah. Reuters reported that systematic stock long-short strategies, the smart autopilots, actually made a 1.1% profit during the March shock.
Oh, so they navigated the crash perfectly.
They did. They saw the panic, found the good stocks being sold too cheap, and bought them. But there's another type of system called volatility-linked or vol control systems.
Yeah.
These acted terribly. They don't look at company value at all. They just measure market volatility.
Wait, so they just look at how bumpy the road is.
Exactly. And if it gets too bumpy, they mechanically sell.
Yeah.
Reuters showed that these vol control systems dumped roughly $108 billion in stocks since early March, purely because volatility ticked up.
108 billion.
Yeah.
Just completely mindless selling.
Completely mindless. And Nomura estimated another $48 billion could be dumped if volatility spikes again. So the huge takeaway for you listening is this. You want systems that seek out good stocks. That's alpha not systems that just mechanically amplify the market's panic.
Okay, so you really have to look under the hood and make sure your autopilot is actually smart, not just reactive. Awesome. So we've got our shock absorbers, we've picked a smart autopilot, but none of that matters if we don't understand the actual terrain our car is driving on, right? Which leads us to the third and final engine macro strategies.
Right. The big picture.
Yeah, I like to think of macro as looking at the weather across different countries. So instead of just betting if the whole ocean will rise, you're looking at which specific boats will rise based on local weather conditions.
That's a great analogy because the global weather right now is incredibly fractured. In 2026, especially with the U.S. under the current Trump administration, global policies are completely diverging.
Diverging how? Like, aren't all the central banks usually on the same page?
They used to be. During the pandemic, everyone cut rates. Then everyone raised them to fight inflation. But BlackRock's 2026 macro outlook highlights that right now, central bank balance sheets and fiscal policies in the U.S., Europe, the U.K., Canada, Australia, and Japan, they are all going in totally different directions.
Because everyone has their own domestic fires to put out.
Exactly. And that creates a perfect environment for a high-breadth, macro investment approach.
So how does an investor actually make money off that?
Well, macro isn't just background noise, it's a direct source of profits. For example, instead of just buying U.S. long-term bonds and hoping for the best, BlackRock prefers shorting, which means betting against European, Australian, and Canadian bonds.
So it's a relative value play.
Hmm.
You're saying, I don't know if the whole world is going up or down, but I know Europe looks worse than the U.S. right now.
You've got it. It's about relative value.
Hmm.
And you really have to pay attention to these global shifts. Reuters reported on April 8th that supply shocks might keep central banks leaning toward higher rates for longer.
Which hurts the emerging markets, right? Because I saw some pretty scary data about that.
Oh, it's brutal for emerging markets. According to the IMF's Global Financial Stability Report, which was covered by Reuters, 80% of emerging market external funding relies on portfolio flows.
Meaning foreign investors bringing money in.
Right. But in March, we saw a staggering $70.3 billion pulled out of emerging market assets.
Wow. $70 billion in 1 month.
Yeah, it was the biggest outflow since the early days of the pandemic. So a good macro strategy sees that money moving and positions your portfolio accordingly.
Okay, this is all fascinating high-level data, but I want to bring this right down to earth for the listener.
Yeah.
What should you actually do with your portfolio? Let's translate this into a practical roadmap. What's the short-term strategy like for the next 1 to 3 months?
So short term, based on all this analysis, your immediate goal is to reduce that hidden concentration we talked about earlier.
Right, the unicycle problem.
Exactly. If your portfolio relies purely on U.S. big tech and long-term bonds, you are highly vulnerable to the exact same shocks. So the data suggests mechanically trimming your large growth stocks, take some profits.
And put that money where?
Diversify into market-neutral strategies, systematic alpha like we discussed, and short-duration credit, along with cash.
Real quick, define short-duration credit for anyone who might not know.
Sure, it just means bonds or loans that pay back in a very short amount of time, like a year or less. They are way less sensitive to interest rate panics than a 10-year or 30-year bond.
Okay, got it. Take some tech profits, buy short-term safe stuff, hold some cash. What about the medium term, like looking 6 to 18 months out?
Medium term, the focus shifts to geographic and revenue diversification. BlackRock notes 2026 is the year of policy divergence, and Reuters mentioned earlier this year that U.S. market leadership might finally broaden out.
So step outside the U.S.
Yes, lower your U.S. megacap bias, add international equities that have clear, real earnings, keep those short-duration government bonds, and make sure you have those uncorrelated alternative strategies acting as your shock absorbers.
So to summarize all of this, you don't just throw away the old 60-40 skeleton. You keep that basic structure, but you bolt on these 3 new engines: the liquid alternative shock absorbers, the smart systematic autopilot, and the global macro weather radar, just to handle the wild, totally fractured terrain of 2026.
That's exactly it. You have to actively build resilience into the portfolio now.
Amazing. Well, before we wrap up this deep dive, I want to leave you with a final lingering thought to ponder this week. Take a look at your own retirement app. Scroll through it and ask yourself, what if the biggest risk isn't the individual things you own, but the terrifying possibility that when a crisis hits, every single one of your diversified investments secretly behaves exactly the same way?
It's a very real possibility in today's market.
It really is. Don't forget to subscribe and hit that like button.